So we continue on lecture number 14 of Stat 761. So we go to problem 10.17. Consider an exchange traded call option contract to buy 500 shares with a strike price of $40 and maturity in 4 months. Explain how the terms of the option contract change when there is a 10% stock dividend, a 10% cash dividend, and a 4-for-1 stock split. So the option contract becomes one to buy 500 times 1.1, 550 shares with an exercise price of 40 divided by 1.1, so 1 plus 10%, that is, okay, which is 36.36. For a 10% cash dividend, there is no effect. The terms of an options contract are not normally adjusted for cash dividends. When there is a 4-for-1 split, the option contract becomes one to buy 500 times 4, 2,000 shares with an exercise price of 40/4, which is $10. So problem 18, if most of the call options on a stock are in the money, it is likely that the stock price has risen rapidly in the last few months. Discuss this statement. The exchange has certain rules governing when trading in a new option is initiated. This means that the option is close to the money when it is first traded. If all call options are in the money, it is therefore likely that the stock price has increased since trading in the option began. Question 19, what is the effect of an unexpected cash dividend on a call option price and on a put option price? An unexpected cash dividend would reduce the stock price on the ex-dividend date. This stock price reduction would not be anticipated by option holders. As a result, there would be a reduction in the value of a call option and an increase in the value of a put option. So note that the terms of an option are adjusted for cash dividends only in exceptional circumstances. So options on General Motors stock are on a March, June, September, and December cycle. What options trade on March 1st, June 30th, and August 5th? On March 1st, it would be March, April, June, and September. On June 30th, it would be July, August, September, and December. And on August 5, it would be August, September, December, and March. Okay. So explain why the market maker's bid-offer spread represents a real cost to options investors. A fair price for the option can reasonably be assumed to be halfway between the bid and the offer price quoted by a market maker. An investor typically buys at the market maker's offer and sells at the market maker's bid. Each time he or she does this, there is a hidden cost equal to half the bid-offer spread. A US investor writes 5 naked call option contracts. The option price is $350. The strike price is $60 and the stock price is $57. What is the initial margin requirement? The two calculations are necessary to determine the initial margin. The first gives 500 times 3.5 plus 20%, remember, times 57 minus 3, which gives 5,950. Then the second gives 500 times 3.5 plus 0.1 times 57, which is 4,600, the initial margin is the greater of these two, or 5,950. Part of this can be provided by the initial amount of 500 times 3.5, which is 1,750 received for the options. So we can remember what those are actually, these formulas, where they come from actually. I stop sharing and I go to John Hall. Okay. Share the screen. Let's try to remember where these formulas came from. Chapter 10. So if you write naked call options, then the initial and maintenance margin required by the CBOE of a written naked call option is the greater of the following two calculations. A total of 100% of the proceeds of the sale plus 20% of the underlying share price less the amount, if any, by which the option is out of the money. And a total of 100% of the option proceeds plus 10% of the underlying share price. So that's what it is. That's where the formulas came from. We can go on to chapter 11. So okay. So list the 6 factors affecting stock option prices. The 6 factors affecting stock option prices are the stock price, the strike price, the risk-free interest rate, volatility, time to maturity, and dividends. What is a lower bound for the price of a 4-month call option on a non-dividend paying stock when the stock price is $28, the strike price is $25, and the risk-free interest rate is 8% per annum? As we can see, it is the stock price, ST, minus K, e to the minus 8% times 1/4 of the year, because it's a 4-month call option. Okay. And so you obtain 3.66. What is a lower bound for the price of a 1-month European put option on a non-dividend paying stock when the stock price is 12, the strike price is $15, and the risk-free interest rate is 6% per annum? The lower bound in this case is the strike price times discounted e to the minus 6% times 1/12. Okay, it's a 1-month European call. Okay, so this is 1/12 minus the stock price, which is ST, which is $2.93. Give 2 reasons that the early exercise of an American call option on a non-dividend paying stock is not optimal. The first reason should involve the time value of money. The second reason should apply even if interest rates are 0. Delaying exercise delays the payment of the strike price. This means that the option holder is able to earn interest on the strike price for a longer period of time. Delaying exercise also provides insurance against the stock price falling below the strike price by the expiration day. Assume that the option holder has an amount of cash K and that interest rates are zero. When the option is exercised early, it is worth ST at expiration. Delaying exercise means that it will be worth the maximum of K and ST at expiration. The next problem, the early exercise of an American put is a trade-off between the time value of money and the insurance value of a put. An American put, when held in conjunction with the underlying stock, provides insurance. It guarantees that the stock can be sold for the strike price K. If the put is exercised early, the insurance ceases. However, the option holder receives the strike price immediately and is able to earn interest on it between the time of the early exercise and the expiration date. Why is an American call option on a dividend-paying stock always worth at least as much as its intrinsic value? Is the same true for a European call option? Explain the answer. An American call option can be exercised at any time. If it is exercised, its holder gets the intrinsic value. It follows that an American call option must be worth at least its intrinsic value. A European call option can be worth less than its intrinsic value. Consider, for example, the situation where a stock is expected to provide a very high dividend during the life of the option. The price of the stock will decline as a result of the dividend. Because the European option can be exercised only after the dividend has been paid, its value may be less than the intrinsic value today. The price of a non-dividend paying stock is $19, and the price of a 3-month European call option on the stock with a strike price of $20 is $1. This risk-free rate is 4% per annum. What is the price of a 3-month European put with a strike price of $20? And for this, we use put-call parity. And so in this case, C is equal to 1, T is equal to 0.5, S0 is 19, K is equal to 20, and R is equal to 0.04. So we just apply put-call parity, which says P plus S0 is equal to C plus K to the minus RT. So therefore, P is equal to C plus K to the minus RT minus S0. And so you obtain $1.80. Explain why the arguments leading to put-call parity for European options cannot be used to give a similar result for American options. When early exercise is not possible, we can argue that two portfolios that are worth the same at time t must be worth the same at earlier times. When early exercise is possible, the argument is no longer valid. Suppose that capital P plus S is greater than C plus K e to the minus RT. This situation does not lead to an arbitrage opportunity. If we buy the call, short the put, and short the stock, we cannot be sure of the result because we do not know when the put will be exercised. What is a lower bound for the price of a 6-month call option on a non-dividend paying stock when the stock price is $80, the strike price is $75, and the risk-free rate is 10% per annum? Well, so it's going to be the stock price minus K e to the minus RT, which is 75 times e to the minus 0.1 times 0.5, because it's a 6-month call. And so that gives $8.66. What is a lower bound for the price of a 2-month European put option on a non-dividend paying stock when the stock price is $58, the strike price is $65, and the risk-free interest rate is 5% per annum? So the answer is the strike price 65, present value, which is e to the minus 0.05, which is 5% per annum, times 2/12, because it's a 2-month European put option, minus $58, which is the stock price, So that gives $6.46. So a 4-month European call option on a non-dividend paying stock is currently selling for $5. The stock price is $64. The strike price is $60, and a dividend of 80 cents is expected in 1 month. The risk-free interest rate is 12% per annum for all maturities. What opportunities are there for an arbitrager? The present value of the strike price is 60 e to the minus 12% times 4/12. Okay. It's a 4-month European call. That's why. So that's 57.65. The present value of the dividend is 80 cents times e to the minus 0.12 times 1/12, which is 79 cents. Because it is the case that 5, which is the call option price, it's selling for $5, is less than 64 minus 57.65 minus 0.79. The condition in equation 11.8 is violated. So let's see. The condition in equation 11.8, let's go see equation 11.8. Sorry. So yes. So this is the condition in 11.8. The condition in 11.8 asserts that let's see, that C is greater than or equal to the maximum of S0 minus D minus K e to the minus RT. So this condition actually no longer holds. That's the point here. So let's go back. Okay. So this condition no longer holds because 5 is less than 64. So 5, which is the value of the 4-month European call, is selling for $5, is less than 64 minus 57.65 minus 0.79. The condition in equation 11.8 is violated. So an arbitrager should buy the option and short the stock. This generates $59, 64 minus $5, which is $59. The arbitrager invests 79 cents of this at 12% for 1 month to pay the dividend of 80 cents in 1 month. The remaining $58.21 is invested for 4 months at 12%. Regardless of what happens, a profit will materialize. Let's see how. If the stock price declines below $60 in 4 months, the arbitrager loses the $5 spent on the option, but gains on the short position. The arbitrager shorts when the stock price is $64, has to pay dividends with a present value of 0.79, so 79 cents, and closes out the short position when the stock price is $60 or less. Because 57.65 is the present value of $60, the short position generates at least 64 minus 57.65 minus 79 cents, which is $5.56 in present value terms. The present value of the arbitrager's gain is therefore at least $5.56 minus $5, which is 56 cents. If the stock price is above $60 at the expiration of the option is exercised. The arbitrager buys the stock for $60 in 4 months and closes out the short position. The present value of the $60 paid for the stock is $57.65, and as before, the dividend has a present value of 79 cents. So the gain from the short position and the exercise of the option is therefore exactly 64.57.65 minus 79 cents, which is $5.56. The arbitrager's gain in present value terms is exactly the difference, which is 56 cents. So that's the way to make an arbitrage, given that we have a violation of equation 11.8. So a 1-month European put option on a non-dividend paying stock is currently selling for $2.50. The stock price is $47, the strike price is $50, and the risk-free interest rate is 6% per annum. What opportunities are there for an arbitrager? In this case, the present value of the strike price is 50 times 6% times 1/12, okay, which is $49.75, because 2.5 is less than 49.75 minus 47, okay. The condition in equation 11.5 is violated. Let's see what is the condition. So okay. The condition is that P, the price of the put, should be greater than or equal to the maximum of K to the minus RT minus S0 and 0, okay. So basically this should be greater, 2.5 should be greater than this value on the right-hand side, but it's not. So basically, an arbitrager should borrow $49.50 at 6% for 1 month, buy the stock and buy the put option. This generates a profit in all circumstances. If the stock price is above $50 in 1 month, the option expires worthless, but the stock can be sold for at least $50. A sum of $50 received in 1 month has a present value of $49.75 today. The strategy therefore generates profit with a present value of at least 25 cents. If the stock price is below $50 in 1 month, the put option is exercised and the stock owned is sold for exactly $50 or $49.75 in present value terms. The trading strategy therefore generates a profit of exactly 25 cents in present value terms. So we will continue in a few minutes.